All right. Put together this little slide deck for you based on global interest rate and the US dollar implications, because we've had a strong week. We're in the middle of a strong week for central bank decisions, and this landscape is always changing, and it has very consequential implications for the US dollar and all of the spot FX pairs that are available for trading through tastyfx. So let's go to the next slide and just give you this global policy rate snapshot right away. All the major central banks here, a lot of numbers, but wanted to try and break it down for you how I thought most interesting, looking at each central bank, where they're currently priced for their overnight rate. And this, as we know in theory, is the kind of trickle-down rate set from these central banks that have implications on all rates across commercial and otherwise. And in the spot FX world, directly commands what the overnight financing charges will be for holding these currencies and for financing using these currencies. And we'll get into it in a little bit, just how that can result in direct benefit or costs to your overnight positions. But here we're looking at, I also added the peaks this cycle because I thought this was interesting. From where are all of these banks falling from? Because we had in 2023 was around the consensus peak for a lot of these major currencies. Inflation rising after that stimulus fallout from the pandemic. Now we're all coming down. A lot of these central banks were in the same place coming down from 2023, but now we're getting a little bit of divergence as we settle on if countries or central banks are already at their more neutral rate, and we tend to see it. I broke it down, the consensus bias right now, at least for what is expected over the coming months and even 2026 as a whole, however people can map it. But we'll break it down by region. But right now, anything surprise to you guys? Just this week we've had, the Bank of Canada this morning, their easing cycle is over. Staying where they are. Their next move, most likely a hike. And similarly, the Reserve Bank of Australia, Australian dollar getting a lift Monday night after they pointed to a hike next, most likely as well. And then we have, of course, the ECB and the Bank of England that traditionally track the Fed. Right now is where we get to that most interesting space that we'll cover in a second, of just when we get around the same at the end of the cutting cycle, just where do rates settle? That could be different for each region. And then the ultra low of the Swiss National Bank and the Bank of Japan, which are expected, a hike expected from the Bank of Japan, but what would that be to maybe max 1%. This is the highest it's been in a long, long time. So this is the current snapshot. Jamal, anything to note?
Yeah, I got a lot. I had to go. I was literally, before we started the show, I was just going back. I've done this before, but it's been a while. I was just going back and looking at interest rates across time, just for us. In my life trading lifetime, if you will, since 2006. I tell you, things were just moving around so much when I was learning to trade. I had no idea what was going on. When we had Fed meetings, and I had to look back to try and remember and see if it made sense. But I started trading in July of 2006. Interest rates were 5.25% at the time. If you would have asked me that at the time, I wouldn't have remembered. I really wouldn't have thought about it. And they stayed flat basically until August of 2007. And I do remember that time because at that point I had my own book. And that's when every single Fed meeting they come out and they'd cut 25 basis points, markets would go nuts to the upside. Wild. And that happened, of course, and then 2008 and all this other stuff. And so the last time, obviously, we were going to cut right now, right? We're going to cut to 3.5 to 3 in 3 orders. And that's essentially the same as, December of 2022, November of 2022, but also equivalent to January of 2008, just looking across times. And it's just interesting to see how different markets react now to, like I said, I'm telling you, every time they cut 25 basis points, markets would go nuts, man. Like I felt like 3 to 4%, like to the upside. It was crazy. You knew it. I mean, you knew it was coming. Like once it happened in July, and once it happened in August, like of '07, then July, like September was the same thing. October was the same thing. And you were able to position yourself and easily make money. It was wild. And that's just not the case anymore. Like it's different. As we sit here, we wait. You just have no idea what's coming. It's a totally different time period. So just that was interesting to look back. But then across what's happened over the last couple of years, I mean, when you look about like your slide here, which is a great slide, by the way, the peak cycle on some of these, we went as high as obviously 5.25, and like you mentioned, I mean, Bank of Canada. I'm sorry, we went to as high as 5.5, but like you said, Bank of Canada, Bank of England, a lot of our major partners, like they basically had to do the same thing. They had the same problems, as they always say. A lot of these countries, when one sneezes, the other catches a cold, and that's what we basically had to deal with, right? I mean, they all had to go up because we all went up. But it's been interesting watching them as we've been coming down. Like you just said, look at a couple of these. They're going to have to possibly race because they went down probably a little too fast. And we know how much heat the Fed has been taking over a while here as far as like their cadence. But I think it's been appropriate. I really do. I mean, I think you can see. As a matter of fact, I remember a year ago this time, I did not think they were going to cut 50 basis points last year when they did.
Right.
Chris and I used to talk about this all the time on Fed Futures Power Hour. I'm like, no way they're going to cut it. Like, why would they do that? And they did. And it was like, wow, that's weird. That's interesting. I still don't understand why we did that. But okay, I guess it worked out well. So it's been an interesting ride here. And look, all of this is, I'm telling all these thoughts of that I got because prior to 2022, I really didn't understand the Fed that much and bonds. And as much as I traded options, I really didn't pay a whole ton of attention to it because it didn't move much. And I always say you learn so much about these things when they move a lot. And I think now we all have a really great grasp on it. And until we get to a point where, I don't know, interest rates don't move a whole ton again, but they've really moved a lot over these last 3 years. I don't know about you guys, but I've learned a ton.
Yeah. I mean, same, absolutely. And to your point of, now it's so much more so on expectations, on trying to price the future, which leaves us a lot of times just like the Fed and the other central banks in a wait-and-see environment as opposed to reactive to actual changes, right? Because a lot of those are already priced in. But I wanted to break this down in 3 buckets because these rates are so consequential for FX trading, not only for the actual, cost to carry overnight financing charges, but also just because you were saying, what is 5%? What was 5% to us in 2007? What is it now? All of these numbers don't exist in a vacuum. When you're trading the exchange rate itself, these are all relative. And so it matters what each is doing and what each will do. So first, on the next slide, I wanted to take a look at who's moving with the U.S. right now, and that we talked about is the ECB and the Bank of England. Traditionally, they are a lot. When we sneeze, what was it? When we sneeze, they cough.
One of them sneezes, the other one's catch a cold.
When we go low, they go low.
One of them sneezes, the other catch a cold. Yeah, you like that one.
I do. I like that.
Feel free to use it. Use it.
I'm 0 for 1 right now on using it, so I got to tighten it up. But yeah, I mean, we've come up together, we've come down together, but now we're at this interesting inflection point where us and the Bank of England are at the same rate, and so right now in terms of spot FX rates, you get this perhaps increased sensitivity around what 1 or 2 cuts might be, because one cut from 5%, is that consequential? Sure, but more cuts are coming. But as we get to this kind of neutral rate, keep an eye out on that euro dollar and that pound dollar to be even more sensitive to data releases or speakers that tell you, perhaps clues as to if 1 cut is coming, if 2 cuts are coming. I mean, the ECB right now is looking at a long hold, not expected to cut in the near future, whereas the Bank of England is slightly closer to us in terms of more cuts are coming. But that isn't to say that, the Fed is already priced in this cut, and so they might be from a market's perspective, already at a standstill of a long hold with only one or two more cuts coming. And so you can even look to that euro pound market for divergences there if you aren't seeing it in the pound dollar market. But it presents some interesting opportunity. But those are the ones most like the U.S. So keeping track of what the Fed is doing will give you a lot of the input for what those countries are doing. On the next slide, we have very interestingly the traditional commodity currencies and their corresponding central banks, the Bank of Canada and the Reserve Bank of Australia, which are now switching back to hiking, albeit not right now. Bank of Canada saying they'll hold with more likely than not a hike than another cut, whereas the Reserve Bank of Australia is more so looking at a hike next. And you know, Jamal, you brought this up that did they overshoot it? Is that kind of the narrative for them right now for these currencies? It's actually not the case of worry that they've overshot it, but particularly in the Australian region, they're now in a great spot where they can react to data releases and say, okay, our growth is positive enough to hike rates back. So not necessarily a bad picture there, but I'm looking most closely at some of those things like those inflation data releases for some idiosyncratic currency risk on that side to the upside. Traditionally, higher rates will bolster that currency, especially when it's on the backdrop of they're doing this in reaction to higher growth and better performance for that economy. So looking to those two currencies to move in tandem, and they also have a relationship with each other in terms of kind of risk sentiment that's been commanding a lot of this narrative so far in 2025. We had the tariff rulings that shocked the Australian dollar the most out of the major currency pairs that I look at, and Canadian dollar as well. Very sensitive to some of those tariff news and developments. And then lastly, switching over to, on the next slide, switching to the players that don't want to play. They don't want to play the rise and falls because they can't or because they've established themselves, like the Bank of Japan, as this player in the global financing landscape, where these will sit. A Japan hike is expected maybe in early 2026, maybe as soon as December. Markets, of course, will react to that, but in terms of interest rate differentials, they're not going to get above 1% anytime soon, if ever. They're coming from zero. The Swiss National Bank did the same kind of hiking and cutting cycle that other European banks did, but to the tune of from negative interest rates to almost 2% and now back to zero. So there's a risk here that this Swiss National Bank may have to go negative again, but for the time being just sitting around zero. And this, when we're talking about interest rate differentials, presents the one of the most popular and interesting trade dynamics for these spot FX pairs in the terms of the carry trade, because we have the U.S. still sitting at 4% and these ultra low banks sitting near zero, and so a bit of a discrepancy there that can yield in the spot market a positive overnight carry to your position if you are on the right side of that trade. Of course, the actual directional risk can many times outweigh this dynamic, because you're only getting pennies in front of a steamroller in most cases, but still an interesting dynamic nevertheless. And we've looked this whole time at U.S. dollar as the front runner for that long position, the one you want to be holding that's yielding the most. But if we keep cutting, maybe something like the euro becomes that highest yielding major currency to hold, and that presents some potential opportunity in pairs like the euro franc, which are historically a lot less volatile because they are so correlated both geographically and economically. And so if you're looking for a low volatility trade, Euro's staying at 4%, Swiss is staying at 0, then that could potentially present another opportunity that doesn't have any dollar risk as we continue falling. So those are the main things, kicking it over the takeaways, why I'm looking at a lot of these things.
I have 2 comments and 1 question before you get to
100%.
First of all, the Swiss S&P is currently at 0%, right? Like I mean, that's like literally the definition of Switzerland, right? I mean, it's like no feeling. And it's so fun. It's so interesting. Like the Bank of Japan, I mean, they're just like the honey badger. They do whatever they want. They totally doing different things different. Final is a question. I had 0 idea. I'm going to tell you right now. CHF. Do you know what that means? The franc?
It is the something Helvetica.
Ah, nice. I had no idea, bro.
It's Latin.
It's like, yeah,
Latin origin.
Confederado Helvetica franc.
Obviously.
Yeah. I never knew that. Never knew that. It's so crazy.
I never knew it before Nick Batista berated me time and time again of how am I supposed to know what these symbols are? I can't see it in the platform. So, yeah, a lot of good call-outs, but a lot of interesting implications for monitoring this landscape as it pertains to which economic data releases should I be looking at, which pairs potentially present a positive carry that could work in my favor, and how will that change over the next 12 months? Does the U.S. dollar not become that major currency in demand as rates keep falling? That's what I'm looking at here on this FOMC Wednesday. Interest rate picture looking funky and fresh for 2026.